Hello folks, Sid Miramontes here, the Miramontes Capital. And in this week's program, I'd like to cover making sure that you have a portfolio that is balanced and how to make sure that you continue to rebalance your portfolio as time goes on. You know folks, we've had many clients over the years, and just reminds me of one of our clients, James, who retired now, about 10 years ago. And we basically set up a rebalancing program for him where his portfolio rebalanced twice a year. And you might ask, well, Sid, what is rebalancing? Well, rebalancing just means that, to give you the simplest examples, means that if we invested your money in 4 different areas and put 25% of your monies in each area equally, so I put 25% in bonds and 25% in large company stocks and 25% in medium-sized company stocks, and say 25% of your money in small company stocks, for example, you have your money in 4 different areas, 4 different investment areas. Well, what happens is, let's say that if markets go down in one area, well, twice a year, what would happen is the portfolio would rebalance. Let's say one gets out of whack. One area grows and grows it to a much higher point, and now it becomes 30% of your portfolio. Another part of your portfolio falls, and now it's 20% of your portfolio. Well, rebalancing means that now it'll move everything back in line. So that means it'll sell those investments at the high price, and then if those investments that were lower price, it'll buy those investments at the lower price, and moves everything back into that 25 example. Okay, so rebalancing just means that it forces you to get a much smoother ride in your portfolio, which is typically what folks are looking for when they retire. And of course, obviously, that's what we're looking for in your retirement. You can rebalance your portfolio once a year. Can you rebalance your portfolio twice a year? You can rebalance your portfolio as often as you'd like. Nonetheless, it does help smooth the ride out on your portfolios. Another thing you want to make sure you do when you're rebalancing your portfolio is, obviously, with the world being what it is and markets being what they are, you still always want to employ the Miramontes method, which means that you want to review your portfolios every 30 to 45 days for the rest of your life to make sure that everything is in line, because that is the only way that we can monitor and check anything. Folks, at any project at work, if you're at work and monitoring a project that's going to be working for the next 30 and 40 years of the company's life, and if you have millions of dollars invested in it, well, you would probably review that project weekly, daily, or at least monthly. Well, we want to make sure you still do that with your retirement assets. If this is your $1 million, your $2 million, your $500,000, your $10 million, that money should be monitored very regularly as well. Even if you have something already in place, if you have a rebalancing program in place to monitor it, you still want to check on it yourself just to make sure everything is running smoothly, folks. So please, just because the rebalancing model is there, doesn't mean that you shut everything else off. You want to make sure that everything is running smoothly. So rebalancing is important to make sure that everything is going to help and balance the ride out, but you also want to make sure that you are reviewing those portfolios with your advisor to make sure that that person is engaged and that you're also engaged with what's happening with your monies. So folks, if you have any other questions on rebalancing or others, we look forward to your time. Thanks so much.